Welcome back to Stock Kong Invest and Analysis, where we look at the market and break down the opportunities.
Like and subscribe!
Fully valued. This article was written by the Asian Investor. Summary: Apple delivered a strong Q4, beating top and bottom line expectations, driven by record iPhone 17 sales and robust services growth. AAPL's services segment hit a new high, with $30.0 billion in revenue, now comprising 21% of total revenues, highlighting its growing significance. Despite recent momentum, AAPL faces top-line growth challenges, with hardware innovation lagging. Apple has the second highest gross profits in the big tech group. I maintain a hold rating on AAPL due to its premium 28x forward PE valuation, limited revaluation potential, and risk of hardware revenue stagnation outside the iPhone category. Apple AAPL beat expectations for its first fiscal quarter in terms of both the top and the bottom line amid strong sales in the iPhone category. Apple was also able to grow its services revenues once again to a new record, with non-hardware revenues now representing approximately 21% of total revenues in Apple's portfolio. Apple's sales success with its iPhone 17 is the main reason why the technology company was able to accelerate its growth in the last quarter. Further, Apple posts strong gross margins and net income profitability, which sets the company up for more stock buybacks in the future. While I like Apple's business, I currently do not see a favorable investment setup in general and maintain a hold rating on shares of Apple only. I downgraded shares of Apple to hold in my last work. Wait for a pullback, as I considered the chances of continued price appreciation low, given the technology company's rich valuation based off of FY 2026 earnings at the time. While Apple has an impressive record of strong capital returns and stock buybacks especially, the consumer technology company has not released any new blockbuster products in the hardware category in recent years. While Apple launched the Vision Pro business in 2024, the company has not yet invented a new product that could challenge the iPhone as the company's leading revenue source. However, Apple had a strong quarter in terms of iPhone sales in Q4 25, which was responsible for an acceleration of the tech company's top-line growth. Apple beat estimates for Q4 25. Apple beat top and bottom-line estimates for the first fiscal quarter on Thursday and published $2.84 per share in normalized earnings versus a market expectation of $2.67 per share. Revenues increased to $143.8 billion in Q4 25, beating the consensus analyst estimate by a massive $5.2 billion. Apple's total top-line growth accelerated to 16% year-over-year in the first quarter, up 8 percentage points quarter-over-quarter, amid booming demand and sales for the firm's recently released iPhone 17. The iPhone release in September 2025 pushed Apple's iPhone revenues to the highest quarterly amount ever, to $85.3 billion, showing 23% year-over-year growth. All hardware products combined saw healthy 16% year-over-year growth, with Mac-related revenues dipping 7% year-over-year, only to be offset by higher, plus 6% year-over-year iPad revenues. iPhones represented a solid 59% of all revenue, up from 56% in the year-earlier period. While iPhones have risen in importance for Apple given the segment's higher revenue contribution in dollars and percent, the technology enterprise has not yet debuted a new blockbuster hardware product that had its own iPhone moment. This year, Apple is set to launch a foldable iPhone, the iPhone 18 with an A20 Pro chip, an updated series of MacBooks, and a new HomePod smart display. However, none of them are true innovations, raising questions about Apple's long-term reliance on iPhone revenues. The important services category achieved approximately $30.0 billion in revenue and saw 14% year-over-year growth. Most importantly, services is now accounting for 21% of all revenue, mainly because of strong growth in its installed base. Today, Apple has more than 2.5 billion active devices that give consumers access to the company's multiple software offers, including Apple Intelligence, Apple TV Plus, and many others. While services reached record revenue in the first quarter, the decline in relative importance is due to the boost in iPhone-related revenue. From a profitability point of view, Apple crushed earnings for its first fiscal quarter, The consumer electronics company generated $42.1 billion in earnings for Q1 26, showing 16% growth year over year as well. This growth was exclusively due to the higher sales volumes in the iPhone segment, as well as consistently strong execution in the high-margin services segment. In terms of gross margins, the picture for Apple is looking very solid for the tech company as well. It had the second largest gross profit, $69.2 billion in Q1 26, in the big tech industry group, with only Amazon being more profitable than Apple. The tech company, however, has a good chance of improving its margins going forward, especially if it continues to grow its revenue contributions from the profitable services segment. If there is one area in which Apple can excel in 2026, it is in the partnership realm. The iPhone 17 has emerged as a major revenue driver for Apple, but partnerships with other tech companies could boost AI product adoption as well as cash generation. Specifically, Apple signed a multi-year partnership deal with Google in January 2026 to consolidate Gemini, Google's AI chatbot, into Apple Intelligence. Further, Apple is extremely free cash flow profitable and has the resources to either splurge on new AI partnerships or invest funds into new acquisitions to boost its top-line growth. Apple's valuation. Shares of Apple are one of the most expensive in the big tech group and are currently trading at a forward price-to-earnings ratio of 28.0x. In my last work on Apple, I rated the tech company a hold, mainly due to concerns about the firm's high valuation based off of earnings. Since then, shares of Apple have fallen about 4%, but may have more downside potential given the firm's elevated price-to-earnings ratio. The industry group average price-to-earnings ratio, including Amazon, Microsoft, MSFT, Meta Platforms, Meta, and Google, is a mere 24.7 times, so Apple demands a considerable premium to its big tech peers. Apple is currently trading at a 14% premium to the industry group average, as well as at a 6%. In the big tech group, I consider Meta to have the best value offer, purely based off of valuation concerns, and the social media company also grew its revenues at double digits in the fourth quarter, set for new all-time highs. While Apple saw accelerated revenue growth in Q1 26, driven by the successful September 2025 launch of the iPhone 17, the stock's premium valuation may leave limited room for more upside. In my opinion, Apple could trade at a fair PE ratio of approximately 25.0x, which would be more in alignment with the industry group average, which means that shares are currently about 12% overvalued. The lower PE ratio, in my opinion, is appropriate given that Apple is too reliant on its iPhones for. The company has not launched an iPhone replacement yet. Based off of next year's consensus estimate of $9.26 per share, and using a fair value PE ratio of 25.0x, the industry group average, Apple's shares could have a fair value in the neighborhood of $231 per share, implying approximately 10% downside revaluation potential. This is a dynamic value, of course, and it could rise with Apple's changing revenue mix. Specifically, a rise in gross margins related to the expansion of the high-margin services business is something that would indicate room for an increase in Apple's fair value. The biggest risk with Apple is that the company will see a moderation of revenue growth in the hardware category over time. While the iPhone 17 is a winner for Apple right now, the consumer electronics giant has not yet managed to debut a major new hardware product in recent years. What would get me to change my mind about Apple is if the tech enterprise were to see slowing iPhone sales momentum in the next few quarters, or if the firm disappointed in terms of developing its gross margins. Final thoughts. Apple submitted a decent earnings report card for the first fiscal quarter that benefited from an acceleration of top-line growth due to higher iPhone 17 sales and strong services performance. Services reached a new all-time revenue record at $30 billion, while iPhones also reported the best quarter ever in terms of sales performance. While Apple has momentum in iPhone sales due to the recent release of the iPhone 17, the company has not brought to market any new innovative products in the hardware category that could carry forward the momentum of the iPhone. Apple is likely going to remain a formidable buyer of its own stock going forward, but I believe that shares are more than fully valued and have limited upside potential in 2026. This article was written by the Asian Investor. Pause.
Hey viewers, like and subscribe to our channel. We'll keep bringing you more insightful stock analysis. It's going to be wild.